for coming out. For those of you that don't know me, my name is David Schlossberg, and I'm a senior partner with the Assured Concepts Group, and we're very thankful that you came out to join us for our event tonight. This is the first time that we're doing this type of format with an Ask the Experts, and so we're very hopeful that we get great questions, and we're even more hopeful that we get better answers that tell us how great 2016 is going to be, right? So, cheers, exactly. I'd like to introduce my partners that are out with us tonight. In the back of the room is Larry Strzelecki. Some of you know him, some of you may not. Yay! Larry! Wait, let me try that again. My name is Dave Schlossberg. And my other partner, Jerry Howell. So on behalf of Assured Concept Group, I'd like, if you would help me welcome four panelists tonight, starting from your left to right. First, I'm going to go first name basis only, because that's the way we are. First, we have Michael with Alliance Bernstein is out tonight. If you would welcome him too. And we have a last-minute substitute. It's like so great that Adam came out with Fidelity, and so we appreciate Adam from Fidelity coming out. We have Manny with Principal Life Mutual Funds. Thank you, Manny. And lastly, Brenda from Pimco Funds. The bond company.
We used to be our tax at ordinary income 20%, long-term capital gains, maybe that drops to 15% long-term capital gains, more simplified tax code. So there's a lot of good positive stuff there that could come about that could affect us on the positive side.
Brenda, would you like to address that one?
Well, sure, I'll just add that, the Republicans are more business friendly. You might look to see Obamacare repealed or changed substantially with a Republican. So there's some positive things that would come out of that. I mean, we aren't spending the money that we're saving from the gas because we don't know what's going to happen to the rest of our money, right? So we're saving it. The only thing that I'll add too is just be glad that that young lady from college that organized the Million Student March is not running for president. If anybody saw that, she was saying that it was all over. It was Neil Caputo, was that his name? Okay, he interviewed her and we played it a couple of days ago at the end of the year, Laughter. And she was saying that the top 1% should just pay for everybody to have a free college education, and we challenged her on that and said if we took all the 100% of the top 1%'s money, that still wouldn't pay for college debt, much less pay for more than 3 years of Medicaid. And she's like, oh, well then go to the next top 1%. Because there'll always be a 1%. So, and you're just like, this is a math lesson, and you try to go along, but you can Google this, or it's on YouTube if you haven't. It's worth a laugh. You can't sleep on that.
Adam, you want to chime in?
I think I could have been back more diplomatically myself.
Michael, any thoughts?
Our firm has always taken the point of view. We have two gentlemen that are in Washington that their job is to analyze policy. That's all they do. And we keep coming to the same conclusion that as an asset management firm, which looks at a top-down and bottom-up approach that mixes quantitative fundamental analysis, politics don't fit into that equation. They'll have short-term impacts on it, but at the end of the day, we live in a free market economy, a capitalistic society. Companies that are producing earnings will grow their stock. Companies that are being prudent with managing their operating revenues, cutting costs, hiring people, wage management, whatever it might be, the fundamentals eventually shine through. So what we say is that, headlines, they plague us every single day. We're bombarded by it. We live in an information age. But at the end of the day, it's all about planning. It's all about conversation with your financial advisor. And don't get caught up in the noise. It's all about the long-term fundamentals.
So would you agree then, thank you, yeah, I agree. You would probably agree that, Michael, that at the end of the day, our valuations are based on the fundamentals, the earnings that occur, and that'll spin out. But the immediate impact of volatility will be dictated by speculation.
Absolutely.
Right.
We're all emotional creatures, and that's what dictates our actions every second of every day. So we can't discount it, we're not trying to be dismissive of it or, belittle its value, but at the end of the day, it's all about the money. Show me the money. Fundamentals.
We actually took a look at the residential, year 1, 2, 3, and 4. Is there a difference in the average return in the S&P 500 between those 4 years? Year 3, which was last year, tended to have a higher return than it will next year, but it's marginal. It's marginal. It's almost like we ran the study and then we came up and said, oh, well, that didn't work. Just to kind of back up on this point there, we've done some research on that, how it affects the S&P, and it's very marginal.
Although this one. Next question. What impact do you think that a few more domestic terrorist type of events might have on our marketplace, such as what happened with San Bernardino? And I could probably for you, Mike. It's all about fun, right? So the real response is maybe the speculators may cause some up or down because of the fear factor, but at the end of the day, the valuation of the stock is going to be tied to its earnings, right? So that leads me into the next question. It's not on the card that I'll ask each of you. Our PEs are relatively high today, historically, and typically that doesn't bode well for double-digit rates of return in the marketplace. So what is your company's, I'll ask each of you to answer this, what is your company's outlook for 2016, and how do you think these might play a factor?
Absolutely. So if you look at the PE on the S&P 500, it's about 17 times today. Historical fair average is around 13. So our expectation, and we always look at the markets on a 5-year forward basis, we expect the S&P to deliver 5.5% to 6% average annualized return for the next 5 years. What that's telling you is that there's going to be a very large dispersion between the winners and losers in the index, as I mentioned in the opening comments. With that in mind, we have a two-pronged recommendation approach. The first one is that you scale down the amount of positions that you have in your equity portfolio, because if we're going to have big gaps in the winners and losers, if you're taking a very broad point of view in the market, you're going to be a victim to that, because you're going to have some of the losers erasing the gains of the winners, and it's where diversification can actually mute some of the returns. By concentrating and looking at companies that we think are positioned on the right side of change, growth-oriented companies, companies that are taking their free cash flows and putting it back into the business, companies that are focused on top-line revenue growth. So very basic things, like I mentioned before, Nike, VF Corp, selling, right? Selling more shoes, selling more North Face jackets. That's going to have a positive impact on those stocks. So muted returns for 2016 and for the next 5 years as well. Real recommendation to have a growth-oriented mindset. Value companies that are actually taking free cash flows, they're putting it back into the business. They're running their businesses a lot more efficiently, so they're shedding non-core businesses. They're focusing on what they do best. And we think that those companies, those that fall with the EPS, earnings per share growth rate expectation of 10% or more, are the companies that are going to be the winners within client accounts. And that's across the board scale down positions.
Thanks. Kind of similar to some of my opening comments, not too dissimilar as far as domestic growth, single digits. It's just about setting the right expectations for next year. It's not going to be 2012, 2013, because we're just not in that phase of the business cycle. We're at the more mature phase of the mid-cycle, and setting the expectations domestically for mid-single digits is probably a good thing. If you're looking for more of a growth tilt, we think there's definitely some good opportunities developed internationally, particularly in Europe. As it was mentioned before, Manny said it, stimulus going on there. I think in the U.S. 5 years ago, we had the same thing going on here. Cheaper valuations in developed Europe. But similar to the comment before, it's international, 75% of the global market cap. It's not a uniform asset class. So maybe not the best place to just throw it into an index or something along those lines. To Mike's point, I think a lot more winners, a lot more losers this year. Concentration is something that we've always preached as portfolio construction. One way to take a look at how you can do it, play into the sectors. It's a great way to add conviction to a portfolio. So instead of investing in the market as a whole, or the 9 style boxes, beyond the 9 style boxes, you can, one way to achieve concentration and to go a little more deliberate to a particular sector that you feel there's an entry point or something like that is to invest directly in that sector. There's plenty of funds out there. With all the fun families out there, not just Fidelity. But we think modest growth in the United States, maybe a little bit more of a growth tilt in developed international. You can get a little bit more of an edge with some of the sectors, and then to Brendan's point, don't forget why we're buying bonds and fixed income is to really curb some of the expected volatility that we're going to anticipate next year.
Thank you.
Yeah, similar comments. We expect 5 to 6% as well. Low to single-digit growth in the U.S. We don't like emerging markets, actually. Going our kind of global asset manager review we just had last week. We're still underweight emerging markets. We think the dollar is going to hurt emerging markets, continue to hurt emerging markets. We talked about commodities. Again, recessions last longer than people think. Those economies, emerging market, they're going to get hurt by that. We do think there's a growing middle class. There's a great underpinning around emerging market equities, even emerging market debt, but we just don't like it. We still think it's still a knife that's still maybe falling. International, we're very overweight. So to echo Adam's comment, we like from a pure PE perspective. To your point, international is cheap. Valuation-wise, it's cheap. The question is, can Draghi do enough? Can they throw the kitchen sink to do enough? And we think they will, but we think from a pure valuation perspective, international is cheap. U.S. equity, again, obviously, I think finding those companies, as Mike said, around the Nikes, the Apples, right? We all buy iPhones, or most of us buy Androids or iPhones. They're going to keep producing products and generate sales. There's no question about it. So finding those companies that look at that top line growth from the fixed income standpoint, as I mentioned before, I think for fixed income, you're going to have to pick your ways where you want to be. Global bonds. Finding that, get paid, go out and get paid for that spread, that income, that credit risk you're taking, get paid for that income. If you look at the 2 best performing asset classes coming out of rising interest rates, and this one's a little bit different because it's Fed induced and we haven't seen a market like this, but the 2 best asset classes have been high yield and dividend paying equities. Companies that grow their dividend, right? Because you're thinking about the bond side, you're discounted, and the dividend paying equity, you're growing that dividend. And I agree 100% with Brett about that. Please do not be in the bonds, because they are going to be the anchor to your portfolio when things get rough.
So Brenda, how much did you pay these guys? When it comes to you answering the question, Brenda, if you don't mind, since people know as the bond company, in addition to giving us the 2016 outlook on equities, can you add the 2016 outlook on bonds?
Sure.
There you go.
We actually don't come out and say we think equities are going to do X. What we come out and say is things like we're neutral on U.S. equities. We see headwinds in commodity prices. We see foreign exchange headwinds with U.S. equities. So we actually favor equities in Europe where Draghi is doing his quantitative easing. We expect more quantitative easing out of Europe. We're a tad concerned about the ability for them to do that. It's like they have the will, but will it actually be effective? And so we're watching that. But we do like European equities. We think they're better valuations than U.S. As far as the U.S. bond market goes, or the global bond market, we don't come out and give a prediction of what the bond market's going to actually do. We like different sectors of the bond market, which we beat like a dead horse, I think, on the panel. So we would say that, yes, there are areas we do like investment grade credit, we like high yield, we're neutral on munis. You've got Puerto Rico in there with that muni situation. So there are asset classes within fixed income like TIPS, treasuries with inflation protection. We like bonds outside of the U.S., countries that are, going a different direction. We're raising rates. The countries that are lowering interest rates. Just think about what happened when we lowered rates for the last, 30 years. It helped our bond market. So we're looking outside the U.S. to other markets where there would be good opportunities. You can still make money in fixed income. You absolutely can make money in fixed income.
What I would say is that what you've been hearing over the last couple of years is there's been a huge shift of money out of active managed funds and into passive ETFs. Now, there's two types of ETFs. There's the cap-weighted, right, that are just buying the index, very simply. Then there's what you call the smart beta, or what some people call tactical ETFs. And they've added a lot of value over the last 6 years, no doubt, because what we ended up seeing is this broad multiple expansion. Companies were buying back their stock. They were making their balance sheets healthier. They were firing people. They were shedding non-core businesses. And the tide lifted all boats. So that environment, it actually worked well. Here's a point of caution to consider. During that environment, if you look at top-line revenue growth, as I mentioned, the variable that actually matters to companies, it's been steadily declining. So it topped out at 10% in 2011. In 2014 was at 4%. Last year we're estimating, the numbers haven't come in yet, but we're estimating around 2 to 2.5%, which is that dispersion that I mentioned. When we talk about investing in that focused company, a company that's going to give you alpha or growth, the opportunity to outperform the index. I'll give you an example. Everybody talks about investing in dispersion, and I mentioned Nike a few times. Nike's a great example of it. It's a great brand. Everybody knows them. You see a lot of people leveraging their products. But they have a disruptive variable inside of them, and it's a new marketing plan called direct-to-consumer. So Nike, and for an average sneaker that they make in Southeast Asia, has about 50 different components, and there's about 30 different hands that have to touch those components to make the finished product. Well, this new disruptive force that they have is the new weaving technology called Flyknit, which is those really beautiful running sneakers that you see in the stores with those neon oranges and neon yellows. That may be a matter of taste, by the way. I'm assuming that you think it's beautiful. But now it only takes them 3 components to assemble the shoe with 1 to 2 hands that touch it. They realized their biggest cost was shipping, so they just moved a huge manufacturing plant to New Hampshire, which is going to service the entire Northeast. Furthermore, everybody's really obsessed with getting to know their health diagnostics with those Fitbit bands. They're putting similar technology inside the sneaker. So you imagine you run 100 miles, you register on their website, you get an email saying, hey, here are your stats and your progression. By the way, here's a 20% coupon of your next pair of sneakers, increasing the turnover. That's what we mean by quality, and that's what we mean by disruption that can take a company to the next level.
You all asked this one, what are your thoughts on real estate investing versus stocks in 2016, i.e. REITs?
That might be a better question for Manning, since he does have a dominant real estate product.
All right, we'll save that one for Manning, but I got another one for you. See, rotating lightning round questions.
We keep it honest there, for sure.
Okay. So, from an investment professional's point of view, and I don't think it was an investment professional that wrote this, but I'll just keep going. From our point of view, what do you think that will happen to the economy under 1, Hillary, 2, Trump, 3, Rubio, 4, Cruz?
I think it's appropriate to circle back on my previous comments that politics are not going to have a long-term impact on our economy. You have to focus on the fundamentals and the quantitative metrics that are underlying with each company that are underneath their investments. The politics, they're going to create noise, they're going to create some waves in the market, but not something that's going to have a long-term impact on a quality company. You know, I always take it back to one of the best investors of all time, Mr. Warren Buffett, who says his investment time horizon is forever, and also says that if I continue to buy companies like McDonald's, like Coca-Cola, things that we leverage every single day of our lives, that it keeps the equity markets efficient, it keeps them growing over the long term, irrespective of the political noise, both inside the U.S. and outside the U.S. any other news that can come out and impact things on the short term, you have to bring it back to the fundamentals. So I apologize, I don't have a specific expectation for different candidates. I think that certainly a change in leadership could be beneficial because I think people are waiting for it. And it's encouraging, and we're a progressive society that wants to see the markets and our political system evolving. But everybody's going to have their own impact, and what they're telling you right now, who knows what they're actually going to implement.
Thank you. Adam, the December rally, also sometimes known as the Christmas rally, did not occur in 2015. Instead, we had a bug this year. So what caused that? What happened?
Yeah, I think one way to kind of look at the markets today is a little bit different. The markets today are moving faster. There's a lot of game changers out there. Markets are moving faster than they have before. So you're going to see some unexpected things. And usually we have times of volatility, and what we do with Fidelity is we determine, is this sustainable? Or is it unsustainable? We make our decisions based on that. Coming out of, I think we got the correction that everybody was waiting for back in August, and it was somewhat sustainable, but didn't quite rupture the market like everybody expected to. It was kind of like a breather, and I think that persisted throughout the rest of the year. It was mostly just based on uncertainty, and it's easy to pick on it, but I'm going to do it. And that was mostly China, and uncertainty around the Fed tightening and the schedule. So once they raised rates, it was kind of like, so that's it. When's the next time are they doing it? Right? There was such a pent up expectation what was going to happen. And I think it was just based on uncertainty, mostly around China and the Fed tightening cycle.
Thank you. Manny, I have a couple directed at you. I'll go back to the one that Michael delegated to you, the real estate question. But I have a two-parter, and maybe they kind of go together. So your thoughts on real estate investing versus stocks in 2016. Piggybacked with, Manny, I think you said property values are back to 2007 levels. We're not seeing that too much here in the Chicago area. When would you expect Chicago to get there?
Well, I'll just hold on, because you mentioned something in Chicago going back to 2007 peaks. Does anyone know what the most expensive apartment sold for New York City in December? It was on 15 Central West. Want to take a guess how much it was?
Too high. Correct.
$45 million. The average median price in New York City in the month of December actually hit just past the 07 level, $1.15 million. So the major markets are going back up. I will tell you with Chicago, and I live in the city of Chicago, what's interesting about the city of Chicago is I do think prices are going up for sure. Part of that has also to do with limited supply, a lot of demand, a lot of limited supply. But the impact that's really I'm seeing in Chicago is rental demand. And that's a kind of across, we're seeing that as a firm actually across, the office I sit at, there's 65 real estate professionals in the office. So we talk a lot about real estate. And apartment rentals are increased with Noah. I mean, if anybody in downtown, how many new construction, I think there's 17 skyscrapers building in Chicago, which is great for our city, thank God, because obviously we have some pension problems, but that's a different notion. So real estate as a whole, we do like real estate. Actually, more importantly, we like mobile real estate, and we touched upon it in a couple different questions. If you think about, again, what's happening in monetary policy, right? The different policy that we're facing in the U.S. is totally different than Australia. It's different than Europe. We actually really like Europe right now. The Eurozone, from a real estate perspective, if you think about the rental growth there, apartment demand is through the roof. One of the things that we really like about real estate in our REIT portfolios is actually, not too dissimilar to what probably Brenda does on the fixed income side, is short duration. What we call short duration. So we like hotels. We like, if you think about malls, like Simon Properties, right? The Oak Brook Mall. Why do we like those? Hotels can adjust their pricing daily, right? If you go down to Chicago at Christmas, it's $700 a night, whatever it is. If you go down in February and first it's cold, it's probably $200. So we like that versus longer lease durations like senior housing and things like that nature. So kind of a similar approach to fixed income, shorter. But global real estate, we do like. I mean, the interesting part about real estate you have to understand, just because there's a rising interest rate environment does not mean you're going to get tons of tailwind. It depends on how quickly rates rise. So we're more in the notion that rates are rising because fundamentals are improving, the economy is getting a little bit stronger, although we do see GDP kind of sluggish, but it is getting better. If we have those type of rates that are rising, it's not as big of a headwind as we see, every quarter or every month when rates are up, 100 basis points. That's a totally different story. So we do like lower real estate versus U.S. equities. I would say, you need diversification. I think it's going to be a good diversifier. Think about it. REITs have about a 0.5, 0.6 correlation to the market, so less correlated than the U.S. stock market. But we think REITs will do good. I don't think they're going to have a 30% return for you if that's what you're getting at. So I think I answered, was it Chicago? I answered the REITs. What was the other one?
That's it.
Okay.
What's your outlook for REITs in Chicago? One more question directed towards you. Lightning round. So real quickly, what are your feelings about where you would invest with giant infrastructure investments coming this year? You go utilities, municipal bonds, stone, cement, steel, building supply.
Yeah, with utilities, I would be a little hesitant because defensive sectors in a rising interest rate environment, there's some headwinds there. We've seen this sort of utility trade for quite some time play. So I guess utilities I would be not so optimistic about.
Thank you. Last one for Brenda. Last of the questions, lightning round, we get to wrap us up. For tonight, I appreciate it. It's an easy one. I think it is. Even though the Fed will raise rates in 2016, aren't these increases likely to be less than prior years?
Aren't they what?
Likely to be less frequent than in prior years.
Yes, very much so. So 04 to 06, the Fed raised rates 17 times in a row. They raised every time they met. They went from 1% on the Fed funds rate, they went all the way to 5.25. So they raised 425 basis points in 2 years, June to June. We're not expecting that. PIMCO has something, at our secular forum several years ago, we came out with we always have a tagline. We came out with a new normal. Now you hear that on every television show, the new normal, but we came up with that was ours. So 2 years ago, we came up with the new neutral. And then this year, our tagline was the new neutral revisited. And so the new neutral refers to the new neutral Fed funds rate. So the Fed, their neutral rate is 4, and that's defined by this Taylor rule that goes through these calculations that comes out with 4% on the Fed funds rate. We're sitting at the Fed funds rate, we raised 25 basis points, so we're 25 to 50 basis points. There's no way we're going to 4% on the Fed funds rate. There's no way. The economy can't withstand it. So if we look at back to the dots, remember the dots? So back to the Fed dots, if we look at the Fed dots, they're saying that at the end of 2016, the Fed funds rate will be at 1.4. That's the Fed governors that actually vote to raise the rate. They're saying 1.4. The market's pricing in less than that, and we're pricing in the middle of that. So we think more than the market. The market's saying 2 25 basis point raises. We're saying that's in 16, and we're saying 3. And the Fed, the people that vote, are saying 4. And they publish those dots 4 times a year at the Statement of Economic Projections come out 4 times a year at a press conference. Another thing to keep in mind is when the Fed raises rates, they always do it when there's a press conference. And they don't have a press conference every meeting. So the next meeting that they have a press conference will be March. And they'll do a Statement of Economic Projection, and the new blue dots will come out. And you can Google that and see what they say.
Last lightning
No way.
question.
Okay, that was
Did
very
the
lightning.
blue dots come from the Blue Man Group? It's seriously a question here, so I need to ask. Well, can we give our panelists a round of applause?